Okay, let's cut the radio show intro, because today we're not just answering one call, we're tackling two of the biggest financial questions that keep people awake at night, pulled directly from the Ramsey mailbag. The first is a question that hits you right after you get out of debt: the emergency fund. How big does it actually need to be? Are we talking a little cushion or a giant mattress stuffed with cash? This is where people get stuck. And the second question, this one is a minefield: the adjustable rate mortgage. It looks so tempting with that low introductory rate. It feels like a secret way to get into a house you can't quite afford. But is it a shortcut to the American dream, or a trap that could lead you to foreclosure? The common enemy here is confusion. It's the bad advice and the complicated financial products designed to benefit the lender, not you. The revelation is this: building wealth isn't about complex strategies. It's about making a few simple, powerful decisions correctly. Today, we're breaking down Dave Ramsey's brutal truths on how to build your financial fortress with the right emergency fund and why you must avoid the single most dangerous type of mortgage. Let's get into it. Number 1, your emergency fund isn't paychecks versus bills. It's your freedom fund. When building your fully funded emergency fund, baby step 3, the rule is to save 3 to 6 months of expenses, not income. Let's be blunt, your income is irrelevant here. This isn't a savings account, it's an insurance policy you pay yourself. It is the protective barrier that keeps a job loss from becoming a full-blown financial crisis. Think of your emergency fund like the foundation of a house. You don't build a foundation based on how tall you want the house to be, you build it based on the weight of the house you actually have. Your monthly expenses are the weight. Trying to save 6 months of income is like trying to build a foundation for a skyscraper when you only need one for a single-family home. It's overkill, and it will keep you from building the actual house. Think of a teacher named Jessica. She was single and a classic overachiever. She heard 3 to 6 months and decided she would save 6 months of her entire gross salary. For 2 years, every extra dollar went into this fund. She made no progress on investing, and she felt broke all the time. Then, a pipe burst in her house, causing $5,000 in damage. Her emergency fund covered it easily, but she realized she'd spent years building a financial bomb shelter when all she really needed was a storm cellar. She recalculated based on her actual expenses and realized she could have started investing 18 months earlier. Stop calculating your emergency fund based on your income and start building it based on what it actually costs you to live. Number 2, deciding between 3 and 6 months is about your risk. The difference between needing a 3-month or a 6-month emergency fund comes down to one word: risk. This isn't about your feelings, it's a mathematical look at the stability of your income. The more volatile your paycheck, the bigger your financial shock absorber needs to be. Imagine you're walking on a tightrope. A 3-month emergency fund is like having a safety net 10 feet below you. A 6-month fund is like having a giant inflatable airbag. If you're a salaried employee with a stable job, you're walking on a thick, sturdy rope. The safety net is probably enough. But if you're a self-employed commission-only salesperson, you're walking that same rope in a hurricane. You need the airbag. Let's look at 2 households. First, a mechanic named Chris who is married to a nurse. They have 2 stable W-2 incomes. They are the definition of low risk. They confidently built a 3-month emergency fund and moved on to aggressively investing for retirement. Now, think about a real estate agent named Sarah. Her income is 100% commission. Some months she makes $20,000, some months she makes $0. For her, a 6-month emergency fund isn't conservative, it's essential. It's what allows her to sleep at night during a slow market without having to panic and sell her investments. Don't choose your emergency fund size based on fear. Choose it based on a logical assessment of your income stability. Number 3, the adjustable rate mortgage is a financial trap, period. You should never, under any circumstances, take out an adjustable rate mortgage, ARM. Planning to pay off a house in 5 years to avoid the rate adjustment is not a plan. It's a naive bet that your life will go exactly as you predict for the next 1,025 days. Life doesn't work that way. Getting a 5-1 arm because you plan to pay it off in 5 years is like jumping out of a plane with a parachute that's programmed to open in 60 seconds, but you're only 50 seconds from the ground. You think you'll land before you need it. But what if there's a sudden gust of wind? What if your timing is off by a single second? The risk is catastrophic, and the reward is minimal. Meet a young couple, Mike and Emily. They found their dream house, but it was just out of reach with a fixed-rate loan. The lender suggested a 511 arm. The payment was lower, and they told themselves they'd get promotions and pay it off before the rate ever adjusted. In year 4, Mike's company had unexpected layoffs. Their income was cut in half, and their plan went up in smoke. In year 5, their interest rate shot up, and their house payment became completely unaffordable. They were forced to sell their dream home, all because they took a gamble on an unpredictable future. You don't build a secure future by gambling on it. You build it with the stability of a 15-year fixed-rate mortgage. All right, let's bring it all together. Your emergency fund is 3 to 6 months of your actual expenses, not your income. Your personal level of income risk determines whether you need 3 months or 6. An adjustable rate mortgage is never an option. The risk will always outweigh the potential reward. The message today is about control. Building an emergency fund based on your actual life gives you control when chaos hits. Locking in a fixed-rate mortgage gives you control and predictability for the single biggest purchase of your life. These aren't just tips. They are foundational principles that separate people who build lasting wealth from those who are always one bad break away from disaster. You have the power to choose stability over risk. I want you to do one of 2 things right now. If you're working on your emergency fund, open your banking app and look at your last 30 days of expenses. Calculate your 1-month expense number. That's your target. If you're thinking about buying a house, go to a mortgage calculator and compare the monthly payment on a 15-year fixed-rate loan versus a 30-year. See the interest savings for yourself.